I'm here today with James Chapman-Andrews. James leads the UK tech team at Alantra. Recently has been involved in a couple of deals that you may have seen headlined in the papers. He helped Graphite buy Babel from LDC, was involved in ECS and Global Logic. He helped sell that to Global Logic. And he's here to talk to us about the market today, in 2021 going forwards, and his thoughts of what's happened from last year, the year that everybody I think wants to forget. But do we really? So where I'd like to start, if I may, James, I'd like to start off with asking a very open question as to what do you see being the outlook for the tech market going forwards in 2021, and what impact do you think the last 12 months has had on it?
Yeah, interesting. Well, first of all, thanks very much for having me, Ruby, and great to be talking to you. So, I think overall the outlook for the UK technology market is incredibly positive. You know, it has actually become, dare I say it, more positive through the course of the pandemic, or sort of post the pandemic hitting, and there was the immediate shock where sort of everything pretty much went, ground to a halt and went on hold for a while over the course of the sort of late spring and into the summer. But I think then very quickly, as people, particularly private equity investors, had shored up balance sheets, etc., in their portfolio companies, then actually minds turned back to the day job, which is clearly deploying capital virtually whatever the market. And obviously, in technology, the most businesses in the space, certainly within software, ICT services, and then all of the areas into IoT, etc., are incredibly resilient, and the market is moving towards those companies rather than away from them. So really the outlook remains the same, if not more positive. Clearly that answers the kind of 12 months question that you had, really the last 12 months question, really, which it's flight to resilience. In doing that, then there's been even a valuation uplift in the technology sector, as it's the same number of assets that there are there, but then there's more, particularly private equity firms and trade buyers looking to buy them. So that's sort of pushing prices up by the simple supply and demand factor. So and then in terms of the outlook, as I say, very positive. I mean, there is a current real driver of CGT, potential capital gains tax changes in the market that, you get various different views, but there's sort of 50-50 between no change probably and, an 8% rise in capital gains tax. But a lot of particularly smaller companies, so sort of sub 100 million founder entrepreneurs, are just very focused on that potential change. But once that's washed through, actually the fundamental market dynamics remain the same from my perspective, as I outlined, and that demand for resilience, growth, cash generation, remains there and is very strong from both trade and private equity buyers.
So based on your comments there, James, would it be fair to say that there's been a positive impact on tech evaluations?
Yeah, I mean, I think that's right. As I say, the supply versus demand dynamic, driven by that flight to resilience, has definitely increased, the value of technology assets, in ICT, or even say in comms services assets, so sort of small part of the overall technology market, but valuations on an EBITDA basis have gone up between 1 and 2 times. I would say, searching for high contracted recurring revenues from a generally large base of customers that's relatively stable, that generated significant amount of cash. That is the resilience of the business model there, even though growth often is not that high, all the way through to businesses that are at the forefront of the technology that they're selling, and therefore seeing very rapid growth as a result. And the pandemic doesn't affect those. If anything, it actually drives more volume to them more quickly, and therefore such a short-term economic shock is actually irrelevant in the scheme of the sort of long-term macro dynamics that those businesses are addressing. So if you look at public company valuations, both software and most areas of comms and networking and IT services have returned and are now ahead of pre-February levels in reality. Part of that is driven by obviously the overall macro dynamic that their interest rates remain so incredibly low that there's a huge amount of cash that is looking for a return. I think the one challenge, to give you a balanced response, is that clearly there is some concern around particularly smaller SME focused businesses, not an allergy to them, because actually there's still a lot of interest in them, but just a question around in the UK where they're very SME focused, then given the amount of government funding support that is going to SMEs through the furlough scheme, or all companies through the furlough scheme, then when that comes to an end, does it create a bit of a cliff edge, if you like, for the SME? They call it the SME death rate rather morbidly, but the SME death rate start going up, and then you start seeing churn in these sort of bigger customer bases of smaller SME customers.
Okay, thank you. What about microclimates? You mentioned a couple of those in that first answer, but things like Brexit, the COVID rollout, what impact, if any, do you think these will have going forward on our market?
Yes, I think, someone said to me recently that in the context of COVID and the pandemic and the effect of that, then Brexit is largely irrelevant, which, what they meant by that is, the effect of Brexit was forecast to be 3%, I think, in the first year or two, low single digit percent impact on output, if you like, for the UK, whereas COVID has been, high teens to even 20% impact. Now, clearly some of that will bounce back, but the question is to what level. But actually, in that context, I think that commentator, if you like, was right in saying, COVID is by far the greater impact that we need to look at and assess. I think in terms of the microclimate, I alluded in that first answer to private equity and the funding still being there. Some private equity funds have said, and they've done their numbers in looking at the mid-market in the UK, and the amount of dry powder in private equity funds in the UK is, I've had estimates between 4 times and 6 or 7 times the amount of dry powder that was available sort of immediately post the global financial crisis in 0809. So, that gives you a sense of the scale of capital that is out there now chasing assets in what could be a downturn, question over what period of time. So, that is a microclimate, or it's really a macroclimate now. It's the amount of capital that is searching for a return because of the lack of return that there is in interest rates, if you like. Mm-hmm. So, I think that those are the kind of main ones to me. I think then in terms of technology, so macro ones specifically, in terms of technology, as I say, the demand for a resilient quality of earnings is, certainly paramount, and investor focus has increased on that, I would say, quite materially. So, and underpinning, beyond that, then in the technology market, then, there are the usual macro drivers, but, it's the shift to cloud, the need for cyber security, the increasing use of automation, AI, you name it. Microclimates from a macro sort of economic dynamics perspective, in a way, they are also macro drivers, if you like, within the technology industry, though. But those are the key bits that will continue driving M&A activity, I think, in the kind of short to medium term.
And James, how supportive are the debt and public equity markets of M&A activity?
I think the debt market is very much so. I'll come back to that. I think in public equity, the real challenge that public equities have, and I'll talk more for the AIM market than the main market, although the point is the same across both of them. But the real challenge that they have had with the rise of private equity in the last 10 to 20 years is that public equity investors are still allergic to leverage, so to debt. So the real challenge that you have when you're looking at floating businesses, as we sometimes do, and IPO activity has returned materially from where it was 2-3 years ago. But really, the amount of leverage that those investors are willing to bear is in the region of 2 to 3 times their EBITDA at the point at which you float the business. And versus private equity that now are very comfortable at, say, 5 to 6 times. So it just gives you an idea. That's the leveraging effect that you can get on the equity that you invest. And therefore that actually often makes public equity just a less attractive route, if you like, for all investors and including the management teams than going with private equity. And that's how private equity has sort of come to the fore so much and makes up a significant part of the M&A market today. So, as I say, IPO market activity is increasing at the moment, and asset prices continue rising in public tech assets. So, I think that balance needs to be refound. I think part of it, as I say, is with the public markets investors being able to or being willing to accept a bit more leverage than they have done historically. Just in terms of debt, I mean, what we saw at the hitting of the pandemic was definitely some nervousness from the senior banks, so the high street banks in the UK, and there's probably still relatively little new lending activity from the senior banks. They're still focused on their existing asset book, clearly, because they have bigger holds in multiple sectors. Then they're facing challenges within some of those sectors that are seeing significant headwinds given the pandemic. Then debt funds, I would say, have made up, because there hasn't actually been a slowdown in activity because there hasn't been the availability of debt. I think that probably the market has just been made up by the debt funds, which that was already happening anyway. But, really, we're now finding out the answer to whether funds are, the debt funds really are loan to own, i.e. are they just putting in this bigger and bigger leverage? So they're going to eventually over lever it and then they own it. That's been the sort of bearish view, if you like, of debt funds. I think actually, this has proven out that isn't the case. Clearly, some of those businesses they've lent high leverage at will face challenges, and then the debt funds will own them. But actually, they've been hugely supportive, I would say, much more so than some people seem to expect of businesses that just needed to shore up balance sheets, move very quickly. And this is where the debt funds have played and managed to make the market that they have made for themselves today versus the senior banks in being that sort of flexible and yet sort of understanding of specific business issues that businesses face in these kind of extraordinary times.
Another question, just follow up from that, is, in your view, what are the key objectives of corporate buyers of private equity when they're making acquisitions?
Well, private equity is the easier one in a way, which, to give a glib answer, I mean, clearly that is an amount of equity that is looking for a return. And, all of private equity's behavior ultimately is driven by that goal. That sort of suggests that private equity don't add value, which I think they materially do. Clearly beyond, though, that is the core aim, because it is always the core aim, however you sort of dress it up. But beyond that core aim, clearly the intent ultimately is to invest in specific macro dynamics like the ones that I talked about earlier, that you just know that there is a growth path. So investing in businesses in certain spaces, unless you really get it wrong or you don't back the right management team, then the chances are that you're going to see significant growth and therefore a return on that value. And then the next piece is, as long as they can add value along the way, then that's why all of the guys in private equity do their jobs, because it's fun and you can help teams to create material value. And I think that's why most PE guys are in the game. In terms of corporates, clearly it's different, and there is a hybrid there, which I won't go into too much. But there's the rise of the private equity backed corporate because of the rise of PE. Then many corporates that you're talking to in sale processes that we run now actually have private equity backing anyway. So is that private equity or is it a corporate? But fundamentally, corporates are looking to either materially change and diversify their business model, which is because there's a new opportunity and there's growth, and or because their existing model needs to fundamentally change, or is or they will die. There's the need to add on additional technology capability, geographic reach and presence, so all sorts of different pillars of the operational structure. And then clearly there is, but people always think it's the first, but normally it's sort of third or fourth, I'd say. There is the synergy benefit that you get from M&A, where you don't need all of the costs, the 1 + 1 = 3 type argument, which is the key element you need to show that a deal has worked, if you like, that it's getting cost synergies, but also revenue synergies from sort of cross-selling, to both customer bases, etc. So I'd say those are some of the key things that corporates are looking for.
Do you know, one of the questions that I've been pondering, and maybe you have a perspective on this, is if technology is a strategic enabler in value creation, then why aren't we seeing more tech businesses acquire non-tech businesses, larger non-tech businesses, and drive value creation through that route?
Mhm. Yeah, I mean, I guess that's sort of a why don't more businesses vertically integrate is how I'd sort of call that. I think that you do see it more. You know, there's a reason that SaaS is called SaaS, so software as a service. You know, it was always the software guys doing the software and the product, and then someone else was providing a service wrap around it. So there has been some merging of software and services. I think that buying a much bigger services business and pushing your tech through it, I think the natural um, counterweight, if you like, to that being the norm is just that services business normally is selling lots of other different software products from lots of other vendors, and therefore you're going to get sort of conflict, if you like, in your channel. And from the vendor's perspective, if you just buy into your distribution channel, then you've been selling into other distributors as well, and then suddenly you're actually competing with them. So I think that there's a natural friction there, but that doesn't mean it doesn't happen. And actually, interestingly, certainly in the voice communication space, as voice technology has moved to hosted, like many technologies, from being sort of on-prem and even on legacy type technology, then actually those providers have been able to have a much more blended delivery model where they can compete quite a bit with their channel before the channel actually starts thinking, well, right, I'm not gonna use you. So I think over time, and certainly over the course of my career, you have seen that increase materially, actually, I would say, versus where it was when I started. I don't think you'll ever see small tech vendors buying big service provider partners, but actually you will see them start to compete potentially with some of their channel.
Interesting. In your experience, how does the transaction affect senior executive team? I mean, is the impact between a deal involving trade different from the one involving private equity?
Yeah, I think naturally, I mean, given the answer that I gave before, then you can you get much more of a mixture with trade, is how I characterize it. So the thing about PE, PE is always or almost always looking to back the existing management team. Now, clearly, some of the team may change, some of the, they may bring new people in, but they are
So,
all.
can I just interrupt you at that point? That's a really good answer, and it's a stock answer I get in the UK. Do you think that varies if it's a non-UK fund, the backing of management team?
Why? What do you mean? So if the non-UK fund then is more likely to bring in their own management team?
No, US
Uh,
funds, if I'm being candid, tend to be a little more upfront about the fact that they're looking at the asset and it's the asset they want to grow and develop. They're not necessarily always backing the management team.
Yeah, interesting. I personally haven't seen that so much, but then I'm not a barometer for that point, if you like, necessarily. I think that the certainly US PE investors are much more au fait with kind of playing around with management teams, although UK funds are increasingly getting there, I would say. But obviously,
Yeah.
it's not kind of strategic intent. And as you say, maybe US funds are just much more open about it and just say, well, right, we want to bring in our team because we've already got a team that have done this 3 times before. I think that that I can understand that logic. I think that there is always, I think, more risk, certainly even than people like me and possibly you, Rupi, the interest of what you do. But I think there's actually more operational risk in changing a management team than you would know unless you've actually been in and operated it or been the PE investor and doing it. Because it's hard yards. It takes a long time. If you get the decision wrong, it takes a really long time because you're having to go through sort of 2 cycles of a year and a half, to work out that it hasn't worked, if you like. So I think that, but I can understand that as part of a US dynamic, if you like. In terms of going back to the kind of trade versus PE, so I think in general, if you take as read, the PE fund will typically try and back the existing management team, or at least enough of it that they're not going to break the business by just totally changing it, unless that's what they want to do. Then I think that you have to look at trade, and then that's much more nuanced. So I've seen trade deals where, ECS that I did recently, you mentioned at the beginning, is a good example. Global Logic bought it, have no presence really in the UK, and they will have the entire management team, other than the chairman, who's non-exec anyway, running that business. That is the aim. Now, over time, it'll probably change, and someone will come over from Global Logic and etc. But that's much more kind of, accretive, aiming to really buy the entire asset and management team and get it to grow with the support of a bigger corporate, but all the way through to, most smaller bolt-ons that the comms and networking platforms do, like Southern Comms or Focus and WaveNet, etc. Will aim to get rid of the vast majority of the management team. They won't always say that. Now, the one thing I would say, because of synergies, clearly, because that's the biggest cost at the top of the P&L, the top of the cost base that they can get rid of, and yet still run the business the way that it should be run, and you get huge accretion, obviously, to profit for that. The one nuance to that, and that's in the middle, is any corporate that is looking at M&A should, and almost always they are, be thinking about, how am I going to get the best team out of both sides of this deal? So I've got my own team, and then I've got that business that I'm buying. And of course, it's a great opportunity for corporates to actually just refresh the entire team, take the best of two teams, which are always going to end up with better than either one of them. And that's really where corporates should be able to realize a huge amount of value in sort of, it's self-selecting in doing the M&A that you're actually going to end up with the best team.
Thank you. And my final question, looking forward at the market in 2022 and 2023, what do you see as being the big trends in tech?
I touched on them a bit earlier, but really, once the pandemic has washed through, but actually even the pandemic, as I said, is kind of irrelevant in the context of these tech mega trends that are going to take place no matter what. It's not a sort of 2-year downturn and then we're back to where we were type thing. This is a really companies that are buying technology of whatever type the company is, taking a 5, 10, 20-year view of their technology needs and how they can use technology to drive their business and create value. The underpinning themes are the shift to public cloud, and that is all anything from infrastructure to voice to Teams, like we're talking on today. All of these are cloud-based services when historically they've been on-premise based services. The increasing complexity of IT ecosystem. So all of our IT, if you think about it, that has only got more complicated over time rather than less. We use more complex applications that are more data heavy, etc. That's the sort of underpinning theme there, is the digital transformation of the workplace. How do we better interact with the information and content that we're all producing and everything to kind of use it and information we're gathering on our clients, customers, etc., and their customers. How do you use that for business intelligence and then to create value? Cybersecurity risk in the context of all of that and everything being online, only goes up. And then I guess the last piece is really the explosion of, big data was a buzzword, 3-4 years ago, but I think it's finally starting to come to pass. It's the proper use of automation technology, be that in, data and analysis, or all the way through to, how do you automate the communication with a customer, AI, chatbots, etc. These were things that were vaunted for a long time, but actually now I think the technologies are starting to become, much more mainstream. So I think those are the key ones, and those themes will run for, way beyond 22, 23 as well. They are fundamentally driving the transformation, if you like, of all of our lives, really, and the tech industry, if you like, is at the heart of that.
Thank you very much. Thank you very much for the investment of your time and talking to me and providing a bit of a view of how we see the market going forward. And it sounds like it's in a positive hue. So thank you.
No, not at all. Thank you very much for having me.